Hi everyone, today we're going over chapter 22. So let me share my screen and we will start going over that chapter. Well, first of all, our questions here are what are the primary phases in the planning and control cycle? Does budget require formal or informal planning? And what are some advantages of this style of management? Well, let me just explain that there's planning and there's control. So planning is actually doing the budget itself for a year, for example, in advance. And then the control part of it is going back as you proceed through that year that you just planned and comparing what you planned to what actually happened, helping you stay in control of your business plan. Does budget require formal and informal? Both. It's good to have a formal budget process. And what about the style of management that goes along with that? Well, for example, in a small organization, in a small organization, budgeting requires planning because of the need to coordinate among various levels of the organization. Advantages of formal planning include communication, and this is, I'm sorry, excuse me, except in small organizations. But in large organizations, yes, then you're going to need to have a formal process because there's larger departments, etc., and you need to develop communications across the departments, etc. Now, for small companies, that can be just done informally between a few people in the company. And what about the next question that we have here? Has to do with the minimum, identifying the advantages and disadvantages of the incremental approach. And here we're talking about, this is going to simplify it because it reduces the time to prepare the budget, focusing on changes from a previous budget and hopefully then going forward. The disadvantages is it's not really focusing on inefficiencies that would have been in your previous budget that you didn't know about. So that's another problem with that one. And what is the minimum level approach to budgeting? This is establishing a base amount for items and requires justification for anything that would go above that amount. So now let's go on. And how does activity-based budgeting predict a cost object's budget? That's 22-5. A cost object is predicted based on anticipated consumption. Because remember, activity-based is based on consumption. So another way of looking at it, explain the continuous improvement concept. Here we're looking at establishing a budget that has improvements built in through the process, and so that the cost can continually be reduced and improved every month. Okay, that could be another way that you might want to look at it. Which budget brings together all the budgets? This is called the master budget, and every budget affects either cash receipts. Well, they're saying the cash budget here, but the master budget includes all the budgets. It includes the cash budget and all the other budgets. But they are correct here that every other budget does affect the cash receipts or disbursements directly or indirectly. So that's where you would see everything flowing to or coming from. But the overall plan is called the master plan. Okay, now what about the budgets are normally used to support the cash budget. What's the result of the cash budget preparations, and what about budgeted financial statements? Well, the sales, purchase, selling expenses, general and admin, and all of that, and other special budgets are going to go under the cash budget. Cash budgets help in the creation of the income statement, which begin with a forecast of sales and then how it will be collected, because you want to know where your cash is coming from, basically. And the budgeted statements are projection of the impact of planned or possible activities for future financial statements. And then the next one, Identify the two budgets as part of the master budget of a manufacturing organization. So the production and manufacturing budgets are a big part of the manufacturing budget. They would be budgeting for everything from raw materials through all the manufacturing processes, etc. So you probably have seen that maybe in managerial accounting, I'm assuming. Okay, and then contrary to the top-down approach and bottom-up approaches, compare and contrast these two approaches, and that's number 11. And the top-down approach begins with management starting at the top and pushing things down. And the bottom-up approach has managers at the bottom within limits establishing their own budgets and pushing them up. Budgetary slack is not desirable because it's basically a built-in cushion. You don't really want that because what if everybody does it a different way, etc. But people tend to do that. So that you have to watch for that. Why are annual budgets not desirable? What are some other methods? They're not desirable when operating cycles don't occur on a 12-month interval. In other words, they may be at a different time of the year, higher or lower. One of the things that you might want to look at there are life cycle and continuous budgets. And then for the next one, explain how continuous works. And in addition to sales forecasts, what other forecasts are you going to look at? Continuous budget is based on moving time frame that extends over a fixed period. And other forecasts would be collections, uncollectible receivable, cost of materials, employee turnover, length of activity, etc., etc. And why should motivation considerations be part of budgeting? And they help prevent and minimize disrespect for the process, padding of the budget, disunity, thinking that one is taking from another, and you want to work toward participative budgeting. And also, if you're going to look at motivating employees to be involved with budgets, you want to encourage participation as one of the major things and look at flexibility in preparation, getting everyone involved and educate everyone about the process. Very important things to do. Now, what about this next problem? 22-17. This is output-input budget, and it says Vineyard Clinic has the following resources: input information available for a routine physical exam. Each exam is 0.7 hours in the examining room, 30 minutes of nursing, and 15 minutes with the doctor. Each exam utilizes one package of supplies and includes benefits, $90 an hour, and nurses can earn $35 an hour with the benefits put in. Variable overhead is $15 per examining room, and fixed overhead is budgeted at $8,000 per month. So what we're trying to do here is prepare an input-output budget when 500 exams are planned. So let's just look at that real quick. Here we have the clinic. We have the supplies that we mentioned, 50 times 500 is 25,000. The nursing services, the physician services, the variable overhead, the fixed, and here's our total budget. Pretty straightforward. That's what it's talking about. The next problem we're going to look at is this incremental budgeting, and here it says Wood County uses an incremental approach, and the current year cash budget for Wood is as follows, and it gives you all the different expenses. And then it asks you to prepare one, and it says that we're going to increase by 3%, and budget details include a budgeting increment for salaries of 3%, no change in rent, 2.5% increases in the budget for supplies. In other words, they're just telling you how to prepare the budget. And here it says a budget increment is 3%, and then it says the planned total is 3%. So you're going to get the others first and back into the one that's missing. So here we go, and we have supplies, and you can see it's all we're asking, remember we had numbers for all of these, and then it told you the overall was 3. So what we did was plug this number, the contingencies and equipment, and we come with the next year's budget of 424,978. Okay, and let's see what we have next. This one, let's just look at the cash budget next. Patrick's Retail Company is planning a cash budget for the next 3 months. Estimate sales revenue as follows. It's telling you what the revenues are. All sales are on credit. 75% is collected during the month and 25% is collected during the next month. After that month, and the cost of goods sold is 70%. Payments for merchandise sold are made in the month following the month of sale. Operating expenses are $125,000 and are paid during the month, during that particular month. And then it says, here's the cash balance on February 1st is $55,000. And we have to prepare a budget for February, March, and April. So with that in mind, here's what this would look like. We would have the cash beginning balances, and each month, you notice, if we have here at the, if we have the 55,000 here, we have 80,000 here, that 80,000 is going here, and then we have 97.5, and that 97.5 is going there. And now we have all the things they said, 75% of current month's sales in the collection, 25% of the previous months, okay, and going across, and then the cash available, and then the disbursements paying the accounts payable for the products, etc. And so we have to have 70% of the previous months all the way across, and then the operating expenses, the total disbursements, and here's our ending cash balance. Okay, and let us look over a little farther here. And here we have an activity-based budget. Well, I'm not going into the exercises. I was just doing the mini. So I am done for now. If you have any questions, reach out to me, please. So what I'm going to do is I'm going to stop sharing. Okay, hi again. Hello, hello. And I'm going to stop recording and see you online.